Welcome to the PaperTrails&RabbitHoles podcast. Today, we are stepping right into the center of, arguably the most significant structural shift in the history of money since we left the gold standard. We are dissecting a fundamental and frankly terrifying question. Is the so-called Great Reset merely a necessary, long overdue software update for a financial system stuck in the 1970s, essentially banking 4.0, or is it the foundation of a global surveillance state?
And that question isn't just theoretical, it's urgent. We are watching the concrete pouring on a new digital architecture right now. The proponents, they call it an evolution toward efficiency. But when you strip away the marketing buzzwords and, look at the actual code being written, it looks a lot less like an upgrade and a lot more like a digital Panopticon.
I appreciate the skepticism, and I know that term, Great Reset, it triggers a lot of alarm bells online. But let's ground this in the reality of the current system. To put it bluntly, it is broken. We are currently operating on financial plumbing that was designed when disco was popular. If you send a wire transfer on a Friday afternoon, it just vanishes into the ether until Monday. Cross-border fees eat up to 7% of remittances sent to the world's poorest families. Billions of dollars are lost annually simply because capital is trapped in transit. This isn't about control. It is about fixing a leaky, expensive, exclusionary pipe system.
You call it plumbing, I call it architecture. And architecture dictates behavior. My argument is that in the quest to fix those leaks, we are building a function creep machine. We are debating whether the convenience of instant settlement is worth building a centralized ledger that, technically speaking, makes financial privacy impossible. You don't build a prison by advertising the bars. You advertise the safety.
Okay, so let's define exactly what we are arguing about here. Looking at the source material, the World Economic Forum, Klaus Schwab, the actual policy papers, the thesis is specific. It is a wake-up call following the pandemic. The goal is a stakeholder economy that utilizes the fourth industrial revolution. We are talking about AI, tokenization, and unified ledgers. The objective is to stop losing the estimated $116.9 billion annually that just vanishes due to settlement flow and friction. This aligns directly with the UN 2030 Sustainable Development Goals. It is about efficiency and sustainability, not spying on your grocery bill.
The stated goal is always efficiency, but look at the social credit system hypothesis. We are seeing the components of a social credit system being assembled piece by piece. Centralized transaction tracking, identity-linked digital wallets, and behavioral scoring algorithms. You mentioned the fourth industrial revolution as a path to prosperity. I see it as a top-down rebranding designed to implement social steering. Even if the intent today is modernization, the capability being hardwired into this infrastructure allows for a level of totalitarian control that no dictator in history could have dreamed of.
You are focusing heavily on potential worst-case scenarios and what-ifs. But let's look at what is actually happening on the ground, in the code. The first major point of contention is the speed of money, specifically the launch of FedNow in July 2023.
Right. The instant payment rail.
Precisely. FedNow is a massive leap forward. Before this, we relied on the ACH system, automated clearinghouse. That is essentially batch processing. You send a payment, it sits in a pile, and gets processed 1 to 3 days later. FedNow is a real-time gross settlement system. It settles in seconds, 24/7, 365. This matters because it utilizes the ISO 2002 messaging standard.
And that standard, ISO 2002-02, is exactly where the problem lies.
Let me explain why it's beneficial first, because this is key to the modernization argument. ISO 20002 allows for structured data. In the old system, a payment message was like a telegram. Very short, very little context. Just account A sent $50 to account B. ISO 20002 is like an XML file. It carries rich data about the transaction. This reduces errors, prevents fraud, and allows businesses to automate their accounting because the invoice details travel with the money. When you cut settlement time from 2 days to 0, you unlock liquidity that can be immediately reinvested in the economy. That is an economic boom.
It is an economic boom purchased with the currency of privacy. You glossed over rich data. Let's be clear for the listener what ISO 2202 actually does. It supports rich remittance data. In the old system, the bank knew I spent $50 at a grocery store. Under this new standard, the data structure supports attaching the actual receipt to the payment message. The system can know what I bought with that $50. Did I buy steak? Did I buy alcohol? Did I buy a political magazine?
That is a technical possibility within the data fields, I grant you. But it isn't the standard implementation for consumer payments.
It is the capability, once the field exists, the temptation to fill it exists. And regarding instant settlement, there is a cost to losing the float. To settle instantly, to prevent overdrafts in real time, the central operator requires total visibility into the master accounts. We are moving from a system of deferred settlement, which naturally had gaps where privacy could exist, the fog of war in banking, so to speak, to a system of total, high-definition, real-time surveillance.
I think you are conflating commercial data collection with central bank surveillance. ISO 2002 is primarily for anti-money laundering, AML compliance between banks. The Federal Reserve isn't interested in your grocery list. They are interested in stopping cartel money laundering and terrorist financing. And FedNow is a back-end rail. The Fed does not hold individual consumer accounts. It settles between banks.
For now is the operative phrase, but FedNow is just the rail. The train coming down the track is Central Bank Digital Currencies, or CBDCs. This is where the Great Reset thesis moves from theory to reality.
I'm glad we're getting to CBDCs, because there is a tremendous amount of misinformation here. If we look at the actual technical pilots, the evidence contradicts the fear-mongering. Take Project Hamilton. This was a massive collaboration with the Boston Fed and MIT. They weren't building a spy tool, they were testing throughput. Phase 1 achieved 1.7 million transactions per second.
Speed isn't the issue. Control is.
But listen to the architecture they tested. The core processor in Project Hamilton, and this is the key part, did not store personal identity data. It used unspent transaction outputs, or UTXOs.
Explain that in plain English for the audience.
Sure. Think of a UTXO like a digital bill in your physical wallet. When you spend cash, you hand over a bill. The bill itself has a serial number, but it doesn't have your name written on it. Project Hamilton was designed to treat digital dollars like distinct objects, not just rows in a database linked to your ID. Furthermore, looking across the pond, the digital euro and digital pound are exploring privacy-enhancing technologies like blind signatures. The European Central Bank has explicitly stated that the euro system would not be able to link you to your payments. They are even designing an offline capability that mimics the anonymity of physical cash.
That sounds reassuring in a press release, but I look at the proposed structural model for almost all these CBDCs. It's the two-tier model. The central bank holds the ledger, and private banks handle the KYC, know your customer. You argue that protects privacy because the Fed doesn't hold the data. I argue it's a massive loophole. In a two-tier model, the government doesn't need to host the data to access it. They just need to compel the private intermediaries to hand it over.
But that compulsion requires legal process, a warrant, a court order. That is the same legal standard we have today with commercial banks. The government can already subpoena your Chase or Wells Fargo records if they have cause. This doesn't change the legal threshold.
Is it the same? This brings me to the time consistency problem. This is a concept from economics. Policies that seem optimal today change when incentives change tomorrow. Laws and software configurations are not immutable. They can be patched. If you build a centralized ledger technology, a CLT, the physics of the system allow for central surveillance. Today, the settings might be privacy-enabled, but in a crisis, a war, a pandemic, that switch can be flipped centrally. You cannot flip a switch and track physical cash in everyone's pocket. You can flip a switch and track every digital token.
You are arguing that because a system could be abused, it shouldn't be built. By that logic, we shouldn't have built the internet because it enables NSA surveillance. But let's tackle your point about crisis. I know where you are going with this. You want to talk about debanking.
Because we don't have to imagine a dystopian future to see financial exclusion used as a political weapon. We just have to look at 2022. The Canadian Freedom Convoy.
I expected this example.
It is the definitive example. The government invoked the Emergencies Act. They froze approximately 280 financial accounts. There were no court orders, no judges signed warrants, there was no due process. They bypassed the judiciary entirely and deputized the banks to freeze assets of protesters. That proves administrative debanking is not a conspiracy theory, it is a reality.
We have to contextualize that or we're being intellectually dishonest. The Canadian situation was a declared national emergency. It was temporary. And significantly, it was subsequently challenged in court, and a federal judge ruled that the use of the Emergencies Act was unreasonable and unconstitutional. That proves the system of checks and balances worked. It wasn't a systemic social credit algorithm running in the background. It was a specific executive overreach that was corrected by the judiciary.
It was a test run. The judge ruled it unconstitutional after the damage was done. And it's not just emergencies. Look at the UK. In the 2021 to 2022 financial year, UK banks closed 343,000 accounts. That is over 1,000 accounts closed every single day. Banks are becoming the privatized police force of the state.
That number is shocking without context. But the Financial Conduct Authority, the FCA, audited this. The vast majority of those closures were for de-risking and anti-money laundering, or AML, compliance. Banks are under immense pressure to stop cartel finance and terrorist funding. If an account looks like a compliance risk, maybe big cash deposits, weird transfers, they close it. They were not closing accounts because of people's political views. It's a compliance issue, not an ideological purge.
But compliance is the mechanism of control. That is exactly what function creep looks like. You create a web of AML and KYC regulations so tight that banks de-risk anyone who doesn't fit the perfect corporate mold. It creates a chilling effect. And when you move to a fully digital tokenized system, that exclusion becomes absolute. You can't just go use cash if the system is fully digital.
But the system isn't going fully digital in a way that bans cash. And regarding social scoring, I have to point to the red line defense. The European Union has taken a very strong stance here. The EU AI Act, which entered into force in 2024, is legally binding. It explicitly bans social scoring. It bans manipulative AI. It bans emotion recognition in workplaces. These are legal firewalls. We are not building China's system. We are building a Western system with democratic guardrails like GDPR and the Right to Financial Privacy Act.
Legal guardrails are just ink on paper. They don't stop the technical capability of programmable money. This is the part that keeps me up at night. We need to distinguish between programmable payments and programmable money.
I agree. The distinction is vital.
Programmable payments are just automation, like a standing order to pay your rent or a split payment, that's fine. Programmable money means the logic is embedded in the currency itself. It means the money in your digital wallet could have an expiration date. It means a stimulus check could have code that says this can only be spent on food, not fuel. Or this creates a negative interest rate if not spent by Friday. It changes the nature of property.
That is a common fear. But if you listen to central bankers, they are actually on your side here. They have stated repeatedly that programmable money, in the sense of restricting how you spend it, would threaten the singleness of money. A dollar has to be a dollar, regardless of where it is spent. If a dollar at the gas station is worth less than a dollar at the grocery store, the currency collapses. What the modernizers want is smart contracts. Look at the PARC project. It's about automated market making, escrow services that execute instantly without a lawyer. This is about economic utility, not controlling your diet.
You say they don't want it, but the tech allows it. If a government wants to stimulate the economy and they have a token that can expire, do you really think they won't use it during a deep recession? It changes the relationship between citizen and state. You don't own the money. You have a license to use the state's ledger under their conditions.
I think that is a slippery slope argument that ignores the economic incentives. If a central bank made money that expired or controlled behavior, people would simply stop using it. They would switch to other assets, gold, crypto, foreign currency. There was a trust deficit they are trying to fix, not worsen, which brings me to the humanitarian case. We cannot ignore financial inclusion.
I'm listening.
In sub-Saharan Africa, mobile money is a lifeline. Remittance fees globally average around 6%, But digital-only channels are pushing that down significantly. We are talking about stopping leaky systems where physical cash is stolen before it reaches the poor. Digital payments ensure the money gets to the person it was intended for. In places like Indonesia and Nigeria, digitizing government payments saves huge percentages of GDP that used to disappear in corruption. This is about fairness.
Financial inclusion is a noble goal, but let's look at the actual adoption, where the rubber meets the road. You mentioned Nigeria. Look at the e-Naira. This was a flagship CBDC launch, and what happened? In the first year, less than 0.5% of the population adopted it.
Adoption takes time. These are new technologies.
It wasn't just time, it was trust. People rejected it because they did not trust the government with their data. They preferred cash or even decentralized crypto. Cash is the ultimate safety valve. In the US, 90% of consumers still intend to use cash. Why? Because it leaves no digital trail. If you remove that option and force everyone into a unified ledger, there is no opt-out. Without an opt-out, consent is an illusion.
I see your point on trust, and the e-Naira struggle is a valid data point. But that is why the two-tier architecture is the preferred model globally. It keeps the government at arm's length. We are moving toward a unified ledger because the inefficiencies of the old system, the delays, the fees, the exclusion are unsustainable in a 24/7 global economy. We cannot run a 21st century economy on 20th century rails.
And I maintain that efficiency is the bait. The hook is the infrastructure itself. We are building a system where, for the first time in history, the issuer of the money has the technical capability to see and permit every single transaction. You rely on laws like the EU AI Act to protect us? I look at history and see that in every major crisis, rights are suspended for safety. The time consistency problem means today's safeguards can be deleted tomorrow. Once the tool exists, it will be used.
It is a tension between efficiency and privacy that isn't going away anytime soon. The Great Reset of finance offers tools that can lift millions out of poverty and streamline the global economy. But it demands we place faith in democratic institutions to hold the line on privacy.
And the skeptic would say that faith is misplaced when the architecture itself removes the need for consent. The risk isn't necessarily a grand conspiracy, but the slow, steady creep of function. The listener has to decide if unparalleled convenience is worth the risk of a digital trail that never vanishes.
That brings us to the end of today's debate. We hope this exchange helped illuminate the mechanics behind the headlines.
Thank you for listening.
Join us next time on The Debate.